Hey, what's going on? It's Lewis here with Crypto Elite, and in today's video, I'm going to be going over my favorite technical indicator called the Fibonacci. I created a presentation for you guys that will show you like everything, what the Fibonacci is, what the numbers are, why it's relevant. And I think that it is so cool because Fibonacci is literally found everywhere in nature. And it's found in trading, not just cryptocurrencies, but also Forex and basically everything and everywhere these Fibonacci numbers are relevant. It'll blow your mind. So check out this presentation. And if you want more information, be sure to follow me on Instagram at CryptoElite. I'm also on Twitter at CryptoElite1. So follow me there. Smash up the likes if this is a good video, if you like it, if you learn something, because this is for entertainment and educational purposes. Now, before we get started, I do need to have a disclaimer out there, which is that nothing in this presentation or anything on like my YouTube channel or Instagram or Twitter or Telegram or any like mode or medium of information or communication, none of that is financial or investment or legal or personal advice. I'm not a financial advisor, and you have to know that investing and trading is risky. So yeah, just because I talk about all this finances and investing and trading and stuff, I am not a financial advisor. I'm not certified or anything like that. And you should always consult with a professional when making financial decisions. Now that we got that out of the way, let's get on to this presentation. So now let's get into Fibonacci and the Fibonacci numbers. This is going to absolutely blow your mind. Let's take a look at these numbers and explain what they mean. Right here you have 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, and so on and so forth. This goes on forever. Now, what the heck does this mean? Well, if you take the first number and the second number and you add them up, that equals the third. So 1 plus 1 equals 2. If you take the second number and the third number, so 1 and 2, and you add those up, that equals the fourth. 1 plus 2 equals 3. The fourth and fifth numbers add up to the sixth. So 1, 2, 3. 2 plus 3 equals 5. 3 plus 5 equals 8. 5 plus 8 equals 13, 8 plus 13 equals 21, 13 plus 21 equals 34, and so on and so forth. This goes on forever. And now this sequence of numbers is called the Fibonacci numbers because it was Fibonacci in 1202 who really made this popular. At around this time, I believe in Italy, Fibonacci was one of the world's greatest mathematicians, and he really brought this mainstream. Now, why are these numbers so incredibly fascinating? Well, these numbers are fascinating because Fib numbers, Fibonacci, also known as Fib numbers, they are found everywhere. If you cut an apple in half, you'll see that there are 5 seeds to it. There's 5 different parts. If you look at the different petals on flowers in nature, you'll see that they always follow Fibonacci numbers. 1, 2, 3 petals, 5 petals, 8 petals, 13 petals, 21 petals, 34 petals. They're always following the Fibonacci number. And what's even more fascinating is that these Fibonacci numbers are in even more places. They're in the number of seeds and fruits, petals on flowers, even in your DNA, and even the shapes of the universe follow Fibonacci numbers and Fibonacci sequences. Now, how is this possible and why does this even happen? Well, you can't really explain it. No one knows exactly why. It is simply a phenomenon that happens in nature everywhere. And the cool thing about this is that you can use these numbers in graphs and trading and charts in every single type of market, including cryptocurrencies. Now here is the really cool thing about Fibonacci numbers. Yes, if you add up 1 plus 1, it equals 2, 1 plus 2 does equal 3, 2 plus 3 does equal 5, and so on and so forth. However, these are much more than just whole numbers. If you take any Fibonacci number and you divide it by its previous number, you will always get around 1.618. This is the golden ratio, and it's also called phi in many instances. This 1.618. This is the magic number right here. Now, of course, if you take the first few numbers, it doesn't necessarily add up to that, such as 1 divided by 1, yes, that equals 1. 2 divided by 1, that equals 2. 3 divided by 2, that equals 1.5. However, once you get into this range, every single number above it, when you do this division of this number divided by the previous number, or this number divided by the previous number, any number divided by its previous number, it will continue to get to 1.618. So, for instance, take 5 divided by 3, that equals 1.66666. 8 divided by 5 equals 1.6. 13 divided by 8 equals 1.625. 21 divided by 13 equals 1.615. 34 divided by 21 equals 1.619. And as you keep on going with these numbers, it gets closer and closer and closer to 1.618. And that is the golden ratio that is found everywhere in nature. Now, I can go on and on about all of the different places that this number and that this ratio is found in. However, I'm going to get into trading and how you can use this, because that's really what you're here for. So the two fibs that you use are the fib retracement and the fib extensions. This video, we'll be going over the fib retracements, and in the next video, we'll be going over the fib extensions. So what does the Fibonacci actually do? The Fibonacci gives you an idea of 1, how far a price will retrace back after a run-up, and 2, how high the price might end up going before it retraces again. So if the price only retraces a little, overall the sentiment of the coin is really bullish. If the price retraces a lot, overall the sentiment of the coin is bearish. And you use the Fibonacci and the Fibonacci numbers to know where the retracements will go down to and where you should buy in. So let's go over that. First things first, let's talk about how to get the Fibonacci tool up in TradingView or Coinigy. This is TradingView right here. What you do is you click this button, which is the pitchfork button, and then you click this button, which is the fib retracement. And this is how you get the fib retracement in TradingView. So let's go do that live. So right here, we have TradingView open on the Bitcoin USD pairing. And in order to get the Fibonacci, we would click this right here. And right next to it, there's a little arrow. You would click that arrow and you would go down to fib retracement. If you're a trader and you like the fib retracement, you'll probably be using it a lot. So you could click this star and add it to your favorites. And now you could see that it just added right here to the favorites tab. So if you click fib retracements now it will be up and you can actually click it. And this is what the fib looks like. So now let's go back to the presentation. All right, so here is the Fibonacci retracement that we have up. And how far will it retrace? How do you know how far back that it will go, that the price will drop to? You use the Fibonacci to do this. So here's an example. I just drew this line up here, and then I took the Fibonacci and I clicked right here and I clicked right here. This gives me the Fibonacci levels for this particular line right here. Now, if it goes down to right here and say it bounces off, that means that it went down 23.6%. If it goes down to this line, which is the second Fibonacci level, that means that it went down 38.2%. If it went down to this level, which many people consider the third Fibonacci level, that means that it went down 50%. Now, just technically speaking, 50% is not an actual Fibonacci level. However, so many people use it in trading that it is respected very often. Now, if it goes down all the way to the 61.8, that means that it went down 61.8%. What did we say before about 61.8%? This is the golden ratio. That means that this is really the best buy zone right here. After a big run up, it will most likely come down and hit the 61.8% before bouncing off. Now, it always has the chance to hit the 23 or the 38 or the 50 or even go all the way down to this 78.6%, which is the very last Fibonacci level before it bounces up. However, the 61.8 is the golden ratio, and this is where it most of the time hits. And this is where I like to start stacking in a lot of my buy orders right in between here And here, in between the 50% and the 61%, I'll have my biggest buy orders right around the 61.8%. Now, if it goes all the way down to the 78%, that usually means that it's a pretty bearish market. And usually in a very bear market, it'll go down to the 78.6% and then bounce off of there. If it goes all the way down and passes the 78.6% and heads down into the 100% retracement, that means that it went all the way down and it retraced from the very, very top of this big run up right here, and it retraced all the way back down 100%. This is very dangerous. This only happens if there's a really big crash in the market or if there's very, very drastic fundamental news that just demolishes the market. This very, very rarely, if ever, happens. So if we continue what we just talked about, this is a big, big run up right here. And then it retraces because every single run up has a healthy correction in order to continue coming up, because nothing could just keep on going up forever. What happens is this case, it went down to the 38.2% and then it bounced off of that and it kept on going up. This, if it bounces off of the 0.382 or the 38.2, that coin is super bullish if this happens. If it bounces off of the 50%, say, that means that it's still pretty bullish. And if it bounces off of the 61.8%, that is slightly bullish. That is pretty bullish still. However, it is getting into neutral territory. And if it goes all the way down into the 78.6%, that means that the coin is getting bearish. If it breaks through the 23, breaks through the 38, breaks through the 56, and then breaks through the 61, after it breaks through the 61.8%, that is an indicator that the coin might be getting a little bit bearish and you might need to start switching up your strategy a little bit. However, it will usually always bounce off the 78.6 if it does not already bounce off of the 61.8. So let's go a little bit deeper with these Fibonacci levels by using Elliott wave theory. Now, Elliott wave theory is really cool and it's very, very easy to understand. What Elliott wave theory says is that price follows this pattern of 5 waves up before making a big retracement. So that means there's 5 waves up, 1, 2, 3, 4, 5, before making a big retracement. Now you can see that there are 2 retracements during the actual Elliott wave up. So there's 1 wave up, and that is a bullish upward trend. And then there is a retracement down, and this makes the level 2 point. Then there's a big upward swing. And then there's another retracement down, and that is the level 4 point. And then there's a big upward swing, and then that equals number 5. And after the number 5, it goes down again. Now with this, you'll notice that the downward swing of number 4 hardly ever goes below the upward swing or the high of number 1. So this will never go down well below it. It'll either stop well above it, or it'll come down all the way and stop at this level, but it hardly will go below it before making an upward swing again. That's rule number 1. And then the second rule is that if the first swing down, which is leg number 2, goes down a short amount, then leg number 4 will go down a long amount. And vice versa. If leg number 2 goes down a long amount, then wave number 4 will go down a short amount. So what does that mean? That means that if leg number 2 goes down, for instance, just to this 38.2, that means that leg number 4 will probably go all the way down to the 61.8. And vice versa, if leg number 2 goes down to the 61.8, then leg number 4 will probably go down only to the 38.2 or the 50%. And the way to use Fibonacci when it comes to this is that you take the Fibonacci from the first wave up from here to here, and that will tell you how far down this wave will go. Then you take the Fibonacci from here to here, and that will tell you how far down this wave will go. However, a big mistake that a lot of people make is that they take the Fibonacci from number 4 to number 5, and they think that they're supposed to do that just how they took it from 0 to 1 and from 2 to 3. However, you're not supposed to take it from 4 to 5. Once it reaches the 5th wave up, you take the Fibonacci from 0 all the way to 5, and that will tell you how far down it will go. Now, don't worry if this is a little bit confusing. We're going to be going over all of this with examples in just a minute. So here is what I'm talking about here. Waves 1, 3, and 5 go up. So that's this right here. Wave 1 goes up, wave 3 goes up, wave 5 goes up. Waves 2 and 4 go down. These are the corrective waves. So it goes up, and then wave 2 goes down, and then it goes up, and then wave 4 goes down. And here's the rules again. If wave 2 retraces a lot, then wave 4 will not. So for example, if wave 2 retraced 78.6%, then wave 4 will probably only retrace 61%, maybe 50%, maybe even 38.2%. Most likely it'll retrace 50 or 61. And here's the other rule. You do your fib from 0 to 1, and then that will tell you how much this is. You do your second fib from 2 to 3. That will tell you how corrective wave 4 will be. But you do not do the fib from wave 4 to wave 5. You do it from here all the way to the very top. So for wave 5, you draw the fib for the entire sequence. And then the other rule that we stated was that wave 4 will never retrace back below into wave 1 territory. This is a general rule. In fact, all of these things that I'm mentioning are general rules. Sometimes the rules do break. However, this is general and it happens most of the time. So let's look at some examples. Let's look at the Bitcoin weekly chart. And let's look at how this weekly chart has been respecting the Fibonacci. If we do this 5 sequence up, this Elliott wave theory up, that's 1, 2, 3, 4, 5, and then we draw the fib from here to here. Let's look at what happened. The first wave down, what happened? The first wave down hit at 50%, and then it bounced back up. The second wave down came all the way down, and what do you know? It hit the 61.8% right here on the dot before coming back up for another week. And then it went all the way down again, and it hit the 78.6% on the dot before coming back up. Now it comes all the way back down and once again hits that 78.6% level, stops right around that 78.6% level. So let's draw this out live. Here's that Bitcoin USD chart. What we'll do is we'll click the Fibonacci and we'll find a level of where we believe the uptrend started. That will be your first point of contact. So it looks to me like this uptrend started possibly somewhere around here because it goes up and it goes down and it goes up and it goes down and it goes up. So if we only use the Fibonacci, not even looking at the Elliott wave, we can click right here, which is the beginning of the uptrend. And then we could click on the bottom and then we could drag it all the way to the top and we could click on the top and we could see where the levels stop and where there were massive support levels and where there were massive resistance levels, because that's what the Fibonacci helps us with. So if we click here and we get a rectangle tool, we could see that after this huge run up, what happened? It came all the way down and it stopped right around here at the 0.5 mark before coming up again. And then it came all the way down. And where did it stop? It stopped pretty close to the 61.8 retracement level. Now this right here wasn't spot on, and that is why I like to stack in my trades anywhere between the 50% and the 61.8% so that you could get your buys in as it keeps on going down and you don't miss it. So what happened after this week when it almost hit that 61.8%? Almost to the dot, it came back up. And then it came back down, and look at what happened here. It came all the way down and nearly touched the 78.6 level. So you could see that sometimes it doesn't touch it precisely. However, it does get very, very close. So that might be a good reason why stacking in your trades instead of just doing one big trade, say at the 0.168 level, you might want to stack them in, stack in a few trades starting up around the 0.5 and just put them in down the line. And the way you would do this is you would put a little bit up here on your first trade, and then you would just get bigger and bigger buy orders as it goes down to the 61.8, or maybe even all the way down to the 78.6 level if you think that it's going to reach that point. If you feel like it's going to reach the 61.8, then you stack your orders in starting at the 0.5 and you get bigger and bigger buy orders down to the 61.8. And that would mean that if it touches the 0.5, at least you got in a little bit here. And if it goes all the way down to the 61.8, then you're not calling the bottom and you end up averaging out at a really good price. If you think that it's going to reach the 78.6, then maybe you'll start a little bit above the 61.8 and you'll stack your buys in all the way down to the 78.6 level, with your biggest orders coming down here. If you would have done that, then you would have gotten in a lot right around this level, which is between the 6,000 and the 7,000 mark, and that would have been a great buy at that time. So I hope you see how on the weekly chart, it respected the fib levels by going down, touching the 50%, going back up, coming back down, touching right about the 61.8%, just above it, coming back up, coming back down, and it stopped. It had a little resistance just below it for 1 week, but then it came all the way down and it touched the 78.6%, came back up, and it came back down. And maybe it'll come back down and touch this 78.6% again. And this was on the weekly chart. Now here's something else that's pretty cool on the weekly as well. If you take the Elliott wave, the 1, 2, 3, 4, 5, and you go like this, bring it 1, 2, 3, 4, 5, and then you draw a fib from 0 to 1, let's see where this level actually ended up. So if you draw the fib right here and you go to 1 and you zoom in, where did this where did this actually come out? Look at this, the 61.8%, directly there. So if you start stacking in your buy orders right here, you would have gotten to the 61.8%. Remember, you go from 0 to 1 on the first Elliott wave. So let's see what happens when we go from 2 to 3, which is the second Elliott wave. Click this, and we draw our Fibonacci from 2 to 3. Where did this come down to? This came down to just about the 50% level. Now, doesn't this make a lot of sense? Because remember, the first one came all the way from here to here, and this dropped down to the 61.8. Well, we know from one of our rules that if the first fib from 0 to 1 drops down to the 61.8 or the 78.6, the second fib from 2 to 3 will drop down from the 38.2 or the 50. It won't drop down as far as the first wave did. And also, it will never drop down past the first wave up. So it will never come all the way back down here. So following those rules, we could say that it's going to hit one of these two numbers. And look at here. It hit exactly pinpoint on the 50% level right there. How about from waves 4 to 5? Well, do you remember our other rule? We do not take it from the low point of 0.4 to 0.5. This would be wrong. Never take it from here to here. This is something that a lot of people do, and they get it wrong all the time. If you do that, then maybe you would have your buy orders right here, and you would think that it will come down to the 61.8, or maybe it will come down to the 78.6. It'll come down to one of these two numbers, and then it will sprout back up again and move back up. That's what you would be thinking if you took it from wave 4 to wave 5. However, you don't do that. What you do once it reaches the wave 5 is you have to go all the way back. You have to get the fib, and you have to start it all the way from the very first point to the top point from 0 to 5. And then this is where you would look at. So now you would say, oh, okay, I'm going to put it in right here, and I'll put it, and this will be the 61.8. And then this right here will be the 78.6. 78.6. This is something that a lot of people do not do, except this is the correct way. And you could see the trend line right here goes from here to here. And if we make this a little bit brighter and a little bit bigger to see, you could see that this now is one trend line, okay? This is one thing. This is one line in a new, and this is what's really cool. This line right here, this now becomes line 1 in a brand new Elliott wave. And then wave 2 will come down and will reach some level over here most likely before riding back up and then coming to wave 3. And this will be very, very cool. So this is going to be the new Elliott wave once we have our first 5 wave in. And so that is how you do this. And now this works great if you're an investor for doing it on the weekly chart. However, what if you want to be a trader? Let's go in to the daily chart. All right, so now we're on the daily chart and let's bring it back a little bit and just see if we could do the Fibonacci and see where we think the prices will go. So if we bring it back all the way to say right here, let's say we are right here and we want to know how far down the prices will go. Well, we'll click this button, the Fibonacci, and we'll go down to the lowest point. This will be the first area that we click, and then we'll bring it up to the highest point. And then we'll say, well, most of the time, what's the magical number? The magical number is 61.8%. So let's see if we think this number will hold. That's going to be the very first thing that I would think of, is just automatically somewhere between, a little bit above the 61.8% to the 61.8%. So let's see what happened. And we'll bring it here. What do you know? Look at all of these buy orders that came in right here at the 61.8%. If you would have been stacking in your buys, getting larger and larger buy orders starting from right here and then bringing it in right here, and they just get bigger and bigger, then you would have made a very, very good trade. And now, why did I choose to go from here to here instead of, say, go from here to here? Well, if we look at the Elliott wave and we count 1, 2, 3, 4, 5, we could see that this is a pretty clear 5 count where it goes up 1, down 2, up 3, down 4, up 5. And if I just make that a little bit more clearly, you could see it a little bit better. All right. And so that's why I took the Elliott wave from here to here, and I thought, oh, it'll probably go somewhere around the 61.8%. Now, here's the thing, though. You have to not only just use Fibonacci, but you have to also keep in mind market sentiment and a lot of other indicators as well, or a few other indicators as well, if you want to get the most accurate picture. So let's bring this, let's firstly delete all of these. And now let's go over to this area, which is around November-ish to December-ish. What was happening at that time, right? There was a lot of irrational exuberance happening in the marketplace, right? So let's see what was happening around this time. And so we'll just go somewhere in November and just see, where do we think it's going to go down to? Here's a good place to do the Elliott wave. And why is this? It's because it goes from it's because right here we have a big round number, which is 10,000, which is usually an indicator that there's going to be some type of retracement there. So let's do the fib from the bottom up to the top. Click there. Where do we think it's going to go? Okay, so in this type of market, when it's in crazy irrational exuberance, okay, I would not really expect it to go to the 61.8. I wouldn't even expect it to go to the 50%. I'd expect it to go to the 38.2. So during these times of irrational exuberance, what should you do? Well, personally, I would hold on to it until I got a confirmation that it's going down. However, let's just see what this Fibonacci says. It definitely wouldn't be all the way down to the 78.6 level. It wouldn't be it probably wouldn't even go down to the 61.8. It'll probably be somewhere around 38.2 because there's so much hype going on. So I would probably just start stacking in my buy orders if I didn't already buy it somewhere down here in between the 23.6 and the 38.2. And what would have happened is that only the 23.6 would have hit. So I wouldn't have bought a lot. However, that's totally fine because I would have caught this next one down, and that would have been a much better setup anyway. And you have to keep in mind that you're not going to catch every single wave or every single run. Also, if there is irrational exuberance and things are just going up, 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 I don't know if that's actually the best time to buy. In fact, I know it's not. The best time to buy is when things are down, and it is the opposite of what the main population is yelling on the streets and the news and everything. If they're all telling you to buy, then you should probably be looking more to sell. And when they're telling you to sell and that Bitcoin and cryptocurrencies is over, that's usually the time to buy because the prices will be really, really low. So even though in this situation, I might not have hit it, or it might not have gone down to the 50 or the 61.8, that doesn't matter because there are so many other setups that come along and you will get massive gains anyway. Okay, so before we go any further and do more examples, I just wanted to zoom out from the Bitcoin dollar one-day chart and just show you something again. So if we take the Fibonacci and we go from, say, the bottom up to the top, and we click there, and we click here, and we click here, and we want to see how far it's going to retrace, well, right here is probably the biggest retracement zone, the 61.8, right? However, there's a lot of sentiment that's very negative in the market once it started going down from 20,000 all the way down to, $11,000, $10,000. So you have to use the sentiment of the market as well. So that is always something to keep in mind, is the overall sentiment of the market, and know how far it's going to retrace. When it's very, very negative, like what it's been around late January and February, the market's probably going to go down between the 61.8 and the 78.6. If the market is really, really bullish, like what it was between November and December, it's probably going to go between the 38.2 and the 50%, maybe even between the 23 and the 38 if there's irrational exuberance happening. So keep that market sentiment in mind as well. Okay, and before we move on, I just want to reiterate one more thing. If you look at this graph right here on the daily chart and you start, at the bottom from where it truly sort of began, and then you do your Elliott waves, you're like 5 counts up, right? And you just go boom, 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 and you go up to the very top. A lot of people, if I didn't mention this before, they went up from the 4 to the 5, and it's just like, look at how perfectly it lined up with the 61.8, right? And look at all of this resistance and support that we had over at the 61.8 level, right? The reason why it fell back down, though, is because this from the 4 to 5, it's not right. You have to take the entire picture in mind. And so you have to go from the 0 to the 5. And if you would have done that, then you would have had a much better, cleaner picture all the way to the 78.6 retracement, which is what we got right around here. So yeah, it's just like, you got to remember to take the entire sequence, and where you start it from, it is subjective. Maybe you started from here, this could have been fine. Maybe you started it from here. If you started from here, then it would have lined up perfectly with the 78.6%. If you would have started it from here, if this is where you think that the beginning of the Elliott wave came, because maybe you thought that the Elliott wave was more like this, 1, 2, 3, 4, 5, and then up here, which is perfectly plausible, then hey, look at this. It still lines up really, really well. So there is some leeway to it, and this is what makes the markets just really exciting is that not everyone puts, their Fibonacci at the exact same levels. Not everyone puts their Elliott waves at the exact same levels. However, what I like to do is I like to look at the market and I like to look at the graph and then plot them to where it makes the most sense. So I would actually probably think that this would make more sense than the other one just because of all the confluence that we have, such as this great support level that I kept on bouncing off of at the 38.2, this resistance right here at the 23, this support at the 50%, and then this support right here at the 78.6%. This just makes more sense to me right now. So perhaps this is the more accurate Elliott wave and Fibonacci sequence. It's really up to you and your intuition on where you're going to start it. If you're going to start it right here, if you're going to start it all the way down here, or if you're going to bring it all the way back and start it all the way down, here. There's different options and it's really to each their own. And of course, if you did it like this, you would have to change your Elliott wave to match it. However, this just, I don't know, it doesn't make that much sense to me, which is why I started it back up here instead. And when looking at this, use other indicators to help support your decision when using the fib. So check this out. If we get rid of this Elliott wave, we can bring in a horizontal line. We could look right here. There was a lot of, support at this level back here. So there's probably going to be some sort of support or resistance here. And if we look over here, we did end up having a lot of support and then we ended up having a lot of resistance. So this makes me think that once we reach this level again, there's gonna be some resistance. Same thing goes for this level right here, just like this general area of around the 50%. There was a little something right there, but then there's a lot of support right here. A lot of buy orders came in, a lot of support, especially around this area. And that lines up with the 50%. This area right here lines up with the 38.2%. So I look for things that make some sense to me in terms of where support and resistance is and where the fib levels line up along with that support and the resistance levels, because there are some times where you'll draw the fib or you'll draw your Elliott wave or you'll draw, something out and it just won't fit. And that's okay. Just don't try to force it if it doesn't, and just try to find different areas, different ways to make it make sense. Like down here, this is the 78.6, and you could see that there was a lot of resistance right here. And what usually happens is resistance turns into support, and there was some support around this area, and now there's some support. If you bring this down a little bit, there was some support around this area. And just, you could see it bounced off of right here, and now it's bouncing and it's staying in this tight little range, or it stayed in this tight little range until it came back up. So now I'm thinking maybe it'll come back down, and it'll come back down right here. Of course, along with the support and the resistance, you also have to use trend lines and volume and overall sentiment and everything like that to make your best decision. However, this is just another addition to the overall Fibonacci equation that I like to use. Okay, and to end this video off, I'm going to go through 3 different examples and just show you how I would use the Fibonacci for investments, which are very long-term swing trades, 6 months, 1 year, 1.5 years. And I'll show you how I do it that way, and then I'll show you how to do it more on the shorter time frame trading. So right here, I have Icon listed up. This is the Icon Bitcoin pairing on the 1 week view on Binance, and this is, once again, this is long term. So what I did was I took the Fibonacci and I put it from here to here. So let me just do that again. I'll take the fib and I'll take it from the low and I'll put it to the high, and I'll see, where do I want to buy in? Where do I think it's going to retrace to? Well, I think it's going to retrace to the 61.8 because that is the golden ratio. So right around here is where I would put in most of my buy orders at. And so I would just stack them in all the way from maybe around here down to the 61.8. And I would have the biggest buy orders right at the 61.8, just above it, because this is a long-term hold. So even though it kept on going down, it didn't really bother me that much, because I know that, or at least in my heart, I believe that Icon will reach way new all-time highs within the coming year. So I don't really mind that it went back down. However, once it crossed this 61.8, I had two options. I could either sell the ones that I bought right here, or I could simply just stack in more buys right around this level from between the 61.8 down to the 78.6. And I could just stack in my buys all around here, getting more and more. So by the time it rebounds, I'll have all of my buys stacked in, short buys right here, and then bigger buys, bigger buys, bigger buys, and I'll have these buys, and it'll look something visually like this, to where my buy orders get bigger and bigger and bigger, and then the 61.8 got really big, and then I saw that it kept on dropping. So then what I would do is I would take this and I would just buy more down here, and what I would do is I would have this, and then I would have a bigger buy order down here, and then I would have a bigger buy order down here, and then once it reaches the 78.6 level, I would have my biggest buy order right around there. And if you could see, it actually would have worked out very, very well. I would have had a great return with my big buy orders right here. And if you would have averaged all of these out, it would have averaged out to probably somewhere around here, which means that I'd still be up. And this is called the dollar cost averaging your way in. I'm not trying to necessarily call the bottoms. I'm averaging my way in, getting bigger buy orders all the way down. And this is for an investment long-term holds. I have faith in these companies. I know what they're going to do. I believe in them, and I don't mind holding them for 6 months, a year, 2 years, even 5 years. I don't really mind holding on to these companies because I believe in the technology. So this is for a long-term investment. This, for example, was for Icon. Let's look at Cardano, also known as ADA. Well, what I did, I drew my fib from the bottom to the top. So let's just take this here and, redo this. Here's the bottom, somewhere around here. Here's the top, somewhere around here. And what would I do? I would put in my buy orders and I would stack them up from around here. And I would just keep on stacking them all the way until it got down to the 61.8. And this is where my biggest buy order would be. And then if it kept on dropping, what I would do is I would just put more buy orders in, and I would put my buy orders in right around the 78.6. And I would just put my biggest buy order right here. And if I would have done that, look at what would have happened. I'd be really, really high in the green right now. I probably would have averaged out somewhere around here for my buys, and that means that I'd be in the net positive, and that's for Cardano if I wanted to do that for my long-term investment. What about for VeChain? Well, for VeChain, I have my Fibonacci level drawn from the bottom to the top. How long do I think it's going to retrace? Well, it'll go from the 61.8, and what would I have done? And what I did do is I have my buys and I start buying in right in between here, and then I bring it up and I have a bigger buy right there, and then I have a bigger buy right there, and then I have my biggest buy at the 60, right above the 61.8. And look at how this worked out. And this is why I like using the 61.8. I don't try to call the 78.6 so much, because what if, I know that on ADA, if I called the 78.6, that would have worked out much better. If I called the, 78.6 on Icon, that would have worked out much better. However, VeChain, what if I called the 78.6 here? It never reached that level. So if I would have just put my buy orders, down here, and I would have stacked them in because I'm thinking, oh yeah, no, it's definitely going to reach this level, I would never have bought my VEN, and then I wouldn't be in the green right now because I would have gotten too greedy and I would have thought, oh, I'm going to place it at the 78.6. That's why I always like to put my buy orders around the 61.8. And you know what? If I miss it, let's say this never even came down to the 61.8. Let's say it stopped off at the 38.2 or maybe the 50%. Yeah, I would miss it. But there's so many trades that are available that actually do hit this 61.8 that I won't really mind it if it happened to bounce off of the 38.2 or the 50% and I missed the 61.8. That's not really that big a deal because so many other trades actually will hit it. And this is for long-term investment purposes. So what if we go back to Icon and we bring it down into the daily? Well, here's the daily. We could extend this out a little bit and we'd still be in the same predicament that we were in the weekly, even if we were doing the daily. And heck, let's even bring it down into the hourly. So now we're in the hourly on Icon, and let's get rid of everything. So now we have this nice clean graph. What we could do is we could do the fib. You know, let's say you start coming from here to here and you want to do this. And what would we have done in this situation? Well, you know, this just experienced a run up of about 62%. So we'll say, all right, let's just put our buy orders in right around here and see if it comes back down to this level. So it came back down, but it never really shot up. So it still has the possibility of coming down. And look at here, it eventually came down to 61.8 and you would have gotten in, you know, right around here. And if this was a really short-term trade, then, you know, you'd have your profit because you would probably put your sell order right where the support used to be, or maybe right where the resistance used to be, and you would put it right there. So you would have made it. And you would have gotten in an 8% profit. And you would have gotten this even if you were being extremely conservative and went in right around the 61.8. And then just about 2 days later, you would have sold right around here and got that 8% profit in 2 days. Not too shabby. Okay, so let's go into another example on, instead of a long-term investment, we'll do a short-term trade. Let's go into VeChain, go into the 1 hour mode. Okay, let's say that this happened, because this happens sometimes, where there is a huge run up. So we want to know how far down is it going to come. So let's say that we're right around here. What we could do is the fib, go from the bottom, go to the top, okay? And I would say right around here is where I would start putting in my buy orders. What happened? Oh, perfectly around this area, right? So this would have been a great job to put your buy orders in, because let's say that this happened, right? Let's say that this happened, and this happens all the time in crypto. A big run up occurs, but you miss it, and you miss the big run up. So where are you gonna get in? Well, just place your buy orders in for the 61.8 retracement right above it, and just stack your orders in, and then you'll get here and you'll put your buy orders in, and then it'll come back up again. And what would have happened here? A good 14%. And if you would have put your buy orders right in here, you know, this is on the hourly chart, and you would have put your sell orders right here at the previous highs, you know, let's see how much that would have been. That would have been a 14% gain, nearly 15% gain, simply in 10 hours. 15% or 14% gain in 10 hours, not too bad. You know, for example, let's say that you saw this gigantic run up and you missed it, and you're like, oh man, I can't believe I missed it. I want to get in on this, and you put your buy orders in here, and let's say you put $1,000 in right here. Hey, you got $140 in 10 hours, and you didn't even need to do anything. Then you saw that this was coming down, right? Let's look for another good setup. So it's going down, so you obviously don't want to necessarily buy anything over here or over here or over here. Let's keep on looking. Okay, here's a possible setup. Take the fib, go from around the bottom to the top, 61.8, this level right here. Let's see where it goes. Boom, 61.8. There you go. So let's say that you put your buy orders in right here. If you did that, you would have gotten about 3.5% profit in about 9 hours. So these are just really small things that you could do if you're trying to, you know, day trade. Oh, here's another one. Boom. Get rid of that. Do the fib from, all right, the bottom price over here to about the top price right here. 50%. Here's the 61.8. Draw my little rectangle box right there. And then let's see. Wow, what a good trade. See, can you see what's happening here? Can you see how amazing this is? Here's the 61.8. So I would have stacked my trades in all along this area, and then I would have saw that it was going down. So I probably would have put a few more trades in starting right around here, which would never have hit. However, I would have hit the majority of it right around here in the 61.8. What you could have done if you were being super conservative is to simply put your sell order at the previous high. There's 6%. 6% in 8 hours. So if you put $1,000 in, that's $60. That's $60 in 8 hours. Not too bad. However, what I like to do, I sort of mentioned this before, is that I like to put my money into these companies that I really, really believe in. So what I'll do is I'll put the 61.8% in, I'll put my buy orders in down here, and I'll just let it ride. I'll just keep it going until I see another like really big parabolic move and I feel like it's time to get out. Or what I'll do is I'll do the fib extensions, which will be in the next video, or I will look at the previous resistance levels. So in this case, if I was doing a short-term trade with this, I would look right here at the previous resistance because you could see at this point it's hit it and it has a hard time busting through here. So let's say that I wanted to buy some VeChain. So I would look right here. I'd see the parabolic run up. I'd put it at the 61.8 and then I would buy my orders and then I would put my sell orders in right up here. And that's an 11% gain in about 1 day and 6 hours. So this is some powerful, powerful stuff. Now, I do want to remind you, though, that you can make it even more powerful. I mean, just doing that alone is incredible. Do not get me wrong. But you can make this even more powerful by utilizing the Elliott wave theory in this analysis, right? So let's bring it down to over here. You could see right here, it's not necessarily just one giant parabolic wave up. Like right here is one giant parabolic wave up. So what I would do is I would probably take it from here to here, or maybe from here to here, right? And then I would put my buy orders in around the 61, the 78. So sometimes it works, sometimes it doesn't. This one, it didn't really work. This one, it didn't work too well because it went all the way back down. However, you could still see that a lot of people did this because of the little traffic jam that happened right around this area and the support and the resistance that came around the 61.8. And that's what I would do in this case over this giant parabolic run up, right? Just like what I did earlier. However, in this case right here, I could see, and this is something that just comes, with time and practice. And I'm not saying I'm the best at this, but I am saying that you need to watch out for these things, that there is a 5-wave theory. So sometimes people, what they would do is they would go from this last parabolic wave up from the bottom to the top, and they would say, okay, 61.8% is right around this area. So let's put a box, right here. And we could even take this fib and move it out to make it cleaner. And they would put it right here. However, that's not good. You don't want to do that because remember, there is this, 5 waves that went up. And when there's that 5-wave theory, you want to do it from the bottom, from point 0 all the way to the top. So now this is where the old 61.8% was. This is where the new 61.8% was. So this is where a lot of people who don't understand this Elliott wave theory would put it in. This is where people who understand the Elliott wave theory would put it in. So let's see what happens. If we keep on going, here's that first 61.8% of this wave up. And you could see it does bounce off of that. So that's cool, right? However, it comes back down and just goes slicing through it, and it goes to this level right here. So this must have been what these people were looking at, and they put their buy orders in over at the 38.2. So if we keep on going, what happens eventually is, there you go, boom, it comes back down and it hits this 61.8 level. And this is one reason why I don't really advocate day trading in very, very short time frames. Because if you were just doing, hourly and you were looking at it every single hour and you did the fib from here to here because you saw that there was a big run up, or even if you did from here to here, then you'd be really screwed. But if you did from here to here and you put your buy orders in at the 61.8, you would buy right here. However, if you were to just be a little bit more patient after it had this big run up and you saw that there was the 5 waves and you started your Fibonacci down here and you put your buy order at the 61.8 right here, and you would have just waited a few more days, you would have gotten in at the 61.8. And let's say you put your sell orders at the previous support, you would have got 6.44% once it reached this area. as opposed to buying it right around here and then only getting around 3.5%. If you were to buy it right here and then put your sell orders at the previous support, which is usually a good time to sell anyway. And that's going to be it for this Fibonacci video. I hope you learned a little bit about it. You learned a little bit about the history. You learned a little bit about how to use it. You also learned a little bit about Elliott waves and how to combine Elliott waves with Fibonacci. And you learned a few rules that go along with Fibonacci and also Elliott waves. So in the next video, we're going to have a little bit of a recap, and then we're going to go and dive a little bit deeper into Fibonacci and the other ways you could use it to see how high a price will go. Because in this video, we went over the retracements to see how low a price will go. You could also use it to see how high a price will go. So we're going to go over that in the next video. So I'll see you in the next video.
Just run away, run, renegades, run to get away. And we just run because we ain't giving it up, how to get away. Always a haunted place.